Hey everyone, and welcome back to the channel. Today we're diving deep into a topic that could save you a lot of heartache and, frankly, a lot of money. We're talking about the biggest portfolio mistakes crypto investors make, and more importantly, how you can steer clear of them. Whether you're just starting out or you've been in the game for a while, these are the pitfalls that can trip up even the most seasoned traders. So grab a notepad, because you're going to want to remember these. Let's jump right into the first and perhaps most common mistake: putting all your eggs in one basket. I see it all the time. Someone hears about the next moonshot coin, gets a serious case of FOMO, fear of missing out, and throws their entire investment into it. This is incredibly risky. The crypto market is notoriously volatile. That one coin could plummet overnight, and just like that, your portfolio is wiped out. True wealth building isn't about gambling. It's about smart strategy. The solution: diversification. And I don't just mean buying 10 different meme coins. A well-diversified portfolio should include established players like Bitcoin and Ethereum, which are often seen as the blue chips of the crypto world. Then you can allocate a smaller portion to promising altcoins in different sectors. Maybe some in DeFi, some in gaming, and some in infrastructure projects. This spreads your risk. If one sector takes a hit, your entire portfolio doesn't crumble with it. Think of it like building a sports team. You need strong, reliable players, but you also need those up-and-coming rookies with high potential. The second huge mistake is letting emotions drive your decisions. We call this emotional trading. You see the market dropping, panic sets in, and you sell everything at a loss. Or you see a coin skyrocketing, FOMO kicks in again, and you buy at the peak, right before a correction. Both are recipes for disaster. The crypto market is a roller coaster of fear and greed. The successful investors are the ones who can detach their emotions from their actions. So, how do you do this? The key is to have a plan before you even invest. Decide on your entry points, your profit targets, and your stop losses. A stop loss is a predetermined price at which you'll sell a coin to limit your losses if the market turns against you. Write your plan down. When you have a clear, logical strategy in place, it's much easier to stick to it when your emotions are screaming at you to do the opposite. Remember, the market doesn't care about your feelings. Trade with your head, not your heart. Mistake number 3: chasing pumps and neglecting research. You see a coin up 300% in 24 hours on social media, and everyone is piling in. It's tempting to jump on the bandwagon, right? But this is often a trap. Many of these rapid pumps are pump-and-dump schemes, where a group artificially inflates the price only to sell off their holdings, leaving latecomers with worthless bags. Instead of chasing hype, you need to do your own research. This is non-negotiable. Look into the project's white paper. What problem does it solve? Who is the team behind it? What are their backgrounds and experience? Check out their community on platforms like Discord or Telegram. Is it active and engaged, or is it just full of bots spamming to the moon? Look at the tokenomics, the supply, distribution, and utility of the coin. A project with solid fundamentals and a real-world use case is far more likely to have long-term success than a coin that's just riding a wave of temporary hype. Put in the work, and your portfolio will thank you for it. All right, on to mistake number 4. And this is a big one: not taking profits. I know it sounds counterintuitive. Why would you sell something that's going up? This mindset is fueled by greed. You think, it went up 100%, maybe it'll go up 1,000%. While that can happen, it's also possible it could crash back down to your entry point or lower. Nobody ever went broke taking profits. A smart strategy is to systematically take profits as the value of your assets increases. One popular method is to sell off your initial investment once a coin has doubled. That way, everything left in the market is pure profit or house money. You're playing with zero personal risk from that point on. Another strategy is to rebalance your portfolio. If one coin has grown to become a disproportionately large part of your holdings, sell some of it and reinvest those profits into other, potentially undervalued assets in your portfolio. This locks in your gains and keeps your portfolio balanced and aligned with your risk tolerance. Remember, on-paper gains aren't real until you cash them out. The fifth mistake is poor security. You could have the best performing portfolio in the world, but it means nothing if it gets stolen. This is a critical aspect of crypto that many people overlook until it's too late. Leaving all your coins on an exchange is convenient, but it's also risky. Exchanges can get hacked or they can go bankrupt. We've seen it happen. The golden rule in crypto is, not your keys, not your coins. This means that if you don't control the private keys to your wallet, you don't truly own your crypto. For any significant amount of money you plan to hold long-term, you should use a hardware wallet. These are physical devices that store your private keys offline, making them immune to online hacking attempts. Also, use two-factor authentication, 2FA, on all your exchange accounts, and never ever share your seed phrase or private keys with anyone. Be skeptical of unsolicited DMs and emails asking for your information. Treat your crypto security with the same seriousness as you would your bank account security. Next up, mistake number 6, having unrealistic expectations. Many people come into crypto expecting to get rich overnight. They see stories of early Bitcoin investors becoming millionaires and think it's the norm. The reality is that crypto, like any investment, is a long game. While explosive gains are possible, they are not guaranteed and often come with massive risk. If you expect to turn $100 into $1 million in a month, you're setting yourself up for disappointment and will likely make impulsive, high-risk decisions. A much healthier approach is to have a long-term perspective. Think in terms of years, not days or weeks. One of the most powerful strategies in both traditional finance and crypto is dollar-cost averaging, or DCA. This means investing a fixed amount of money at regular intervals, say $50 every week, regardless of the price. When the price is low, you get more coins. When the price is high, you get fewer. Over time, this averages out your purchase price and reduces the risk of buying everything at a market top. It's a disciplined, steady approach that builds wealth over time. Be patient and consistent. The final mistake we'll cover today is ignoring the tax implications. This can land you in serious trouble. In many countries, cryptocurrencies are treated as property, and you owe taxes on your gains. Every time you sell crypto for fiat currency, trade one crypto for another, or even use crypto to buy goods or services, it can be a taxable event. Many investors simply aren't aware of this or choose to ignore it. But tax authorities are becoming more sophisticated in tracking crypto transactions. The best way to handle this is to be proactive. Keep meticulous records of all your transactions, the date, the type of coin, the amount, and the value in your local currency at the time of the transaction. There are many crypto tax software services out there that can connect to your exchanges and wallets to help you track everything automatically. At the end of the tax year, you'll have a clear report to give to your accountant. Don't let taxes be a nasty surprise. Plan for them, and you'll sleep much better at night. So to recap, diversify your holdings, control your emotions with a solid plan, do your own thorough research. Don't be afraid to take profits. Prioritize your security with a hardware wallet. Maintain realistic expectations with a long-term view, and keep track of your taxes. Avoiding these common mistakes will put you light years ahead of most people entering the crypto space. It's about being smart, disciplined, and patient. Thank you so much for watching. I hope you found this guide helpful and that it empowers you to build a stronger, more resilient crypto portfolio. If you got value from this video, please hit that like button and consider subscribing to the channel for more content like this. Let me know in the comments which mistake you found most eye-opening. Stay safe and invest wisely. See you in the next video.